It appears that the recession has just started. The economic analysts expected us to slow down by the end of the year, yet we started much early. By their prediction, rather than growing by at least 1.1% this year, the economy shrank by 1.4%, suggesting that we are now arriving in a recession. Since the beginning of the year, we've lost 13.3%, which now indicates that we are in a bear market. Now, it seems like we've been in a lot of yet another once-in-a-lifetime economic crisis. To understand better, let's discuss the condition of the market, and then I'll show you precisely how we'll prepare for it. Hey guys, and welcome back to this channel. This is Chad Confirmed, bringing you the hottest news in the crypto world. To give a brief background, what's influential in the markets is the committee, specifically the Federal Open Market Committee or FOMC, which discusses future interest rates trends. In addition, Jerome Powell will enlighten the people about the federal fund rate increase. Keep in mind that the federal fund rate has the greatest impact on the cost of debts, and during that time, the market expects us to rise interest rates by 0.5%. There are a lot of baseless rumors and predictions going around, but one way to know for sure is to verify its reliability. And to do that, we will be using the website CME Fedwatch tool, which helps in predicting future interest rates in accordance to what investors are trading. Basically, it works like this. The 30-day Fed Fund Futures market is used as a source of data for this analysis. It's called the 30-day Fed Fund Rate market mainly because these contracts are issued every 30 days. This is where investors bet and speculate about short-term interest rates. The exchange works differently here. To put it in a simple way, let's say we predict rates to be 1%. So we deduct 1 from 100 to get a $99 amount. Pretty simple. In order to make predictions about the market, Fedwatch collects and analyzes a substantial amount of data and information. So now, I'll show you how to make use of this information on your own. Starting off, search the website www.cme.group.com/interest-rates/countdown-to-FOMC.html. Once opened, you'll need to first click the dates found at the top of the page. Like for example, we'll first click July 27, 2022. From here, 2 bar graphs will appear. On this date, the current target rate is between 150 and 175 basis points, which you can see at the top of the page. But what does that mean? It signifies that only 1.50 to 1.75% of people are affected by this, because 1% is equivalent to 100 of a percentage point. Now you might be wondering, why do they use this typical point system when they could just simply use the percentage format? But the reason they do this is to avoid further confusion. Let's say interest rates are now 7% and I inform you that they increased by 1% today. You could assume that they are now 8%. But what I actually mean is that 1% of 7% is 0.07%. As a result, the rate is now 7.07% rather than 8. They are utilizing these foundation points because it provides you an objective way to measure your progress, and that's why it's so complicated. Now, Going over to the bar graph again, the left bar indicates the current target rate and the probability of maintaining that value, while the right bar shows where interest rates are expected to be in the near future, which according to here is between 225 and 250 points. On the other hand, there are indications that during the Fed meeting, Powell will declare that once the bank hikes interest rates again, it might be as much as 75 basis points. It is clearly one of the most significant boosts we've made in a long time. To further apply this, let's go back to the top part of the graph showing the dates and select a different date like September 21, 2022. Since the federal fund rate is signified by the first bar, we can assume here that it's between 250 and 275 basis points as September 21st, with a 9.5% chance that the federal fund rate will be maintained once this date comes. Looking over to the second bar, it shows that there's a staggering 66.2% probability that the interest rates will be within the range of 275 and 300. As you select the months ahead, you'll notice the difference where it adds an additional bar in the graph, since it signifies more opportunities. In other words, the pattern here is whenever we move further into the future, more bars open up. As a result, we must account for a wider range of alternatives. This, in turn, could be crucial in accurate prediction of the future rates. Now that you have a little knowledge in navigating the Fedwatch tool, what can you say about it? Is the target rate possibility something you will trust? I would like to know your thoughts in the comment section below. And if you know someone interested in not losing money this recession period, then share this link for them to watch. Moving on, let's delve in deeper into how the stock market will respond to a 0.5% rate increase when the time comes. According to Michael Malonsky in Investors Business Daily, ever since June 1989, there have been a total of 5 rate hikes of 50 basis points or more, and the most recent one was in May 2000. So, if we'll have another 50 basis point increase this year, it would be another record in the history books. As you can see here in the table from Dow Jones market data, both before and after the announcement of the rate rises, the markets responded unfavorably. Nonetheless, during the 2-week period following the rises in interest rates, the stock market rose considerably in certain situations. To help you prepare, we'll now discuss how to do so. Keeping your cash or investing it will only lead you to lose more money. Either way, your losses are likely to be substantially greater. One way to not lose your money is through the help of I-bonds, which are now generating 9.6%. I-bonds are a type of savings bond and are safe investments designed to protect the value of your cash from inflation. Additionally, I-bonds are exempted from taxes, making them better as a low-risk investments for investors who usually pay high tax rates. Despite all these, we should be 100% laid back. Historically, we've experienced tons of recessions and we're lucky enough to survive some of those with high returns. And there are times where there are huge losses. But the point is, the odds of gaining or losing money in the stock market during a recession are not in our hands and favor all the time. Nonetheless, these considerations will do help in the long run. That's all for today. If you learned something new, like this video and make sure you hit the notification bell so you won't miss any of our uploads. Let me know in the comments below what your thoughts are on this video. Kindly subscribe if you haven't already. This is Chad Confirmed, signing off.